Good afternoon, everyone. I'm Carla Zevnik-Seifzer, and as many of you know, I'm both an advisor and the president of ClearStep Financial. And I would like to welcome you to today's presentation, the 2026 Tax Planning Strategies and Key Updates. So our goal at ClearStep Financial is to help create and educate and guide our clients through our ever-changing financial world. To help us accomplish this goal, I am pleased to introduce to you today our guest speaker, Mike Barrett, a CPA with the firm Mazanek, Bauer and Associates. And I believe you will find this presentation both educational and informative. So with that, I'm going to turn it over to Michael. Thanks, Mike, for being on the call.
You bet. Yeah,
And
thank you,
then,
Carla, for the nice introduction.
so Mike,
And
would you like us to ask questions at the end?
um, yeah, I can. Yeah, I'll leave some time for questions at the end. Maybe I'll just kind of go through the presentation here. I'm going to share my screen, and we'll kind of get started here.
Or you could put the questions in the chat as well, those of you that are on the call.
Okay, and then can I share my screen here? Okay, Carla. Let's see.
Yes, should be able to.
Just okay. Here we go. Okay. All right. Do you see on the screen there? Okay.
Yes.
Okay. All right. Very good. Okay. Yeah, so I'll start out. There were quite a few changes this year to tax law, so it's a great year to go over changes. Not every year there are so many updates. Um, there normally are just some inflation adjustments made, and this year that applied as well. So we'll kind of just start there. Um, just to let you know what those amounts are for IRA contributions. Um, for 2025, 7,000, and then 2026 going up to 7,500. And then the catch-up amount was 1,000. It'll be 1,100 for 2026. Um, we You could kind of see what the Roth phase-out amounts change to, and just the traditional IRA deductible phase out range is. So that would be if your spouse was covered by a plan but you aren't, that would be the range you would use to determine that. Um, Even with that, just a reminder, everyone with earned income can make an IRA contribution, whether it's Roth or traditional. The question on the traditional is whether it can be deductible. And then, of course, there are ways to get dollars in there, even if you are not eligible to make a Roth due to income phase outs. You could look at some backdoor Roth conversion possibilities. These are the updated amounts for 401k elective deferrals. For 2025, it was 23.5. It goes to 24.5. Catch up goes from 7,500 to 8,000. So that's again for anyone 50 or older. And then the super catch up is something I think some people aren't aware of. But if you're 60 through 63, you could actually do even more. For 2026, that catch up has to go to a Roth, which is kind of a caveat that you'll have to watch for. And some companies may have to update their plan to allow for that. So that is a new wrinkle for 2026 to be on the lookout for. The annual gift exclusion. So this would be the amount of a gift you could give to an individual in a calendar year without any reporting requirement. That amount stays at 19,000 as it was in 2025. Just a reminder here, a couple can make joint gift, of twice that amount to an individual, can multiply that even more if you're making it to, say, a son and daughter-in-law, for instance, or other family members. And that can certainly make gifts larger than this in a year. There just then would be a gift tax reporting requirement that normally would not cause any gift tax to be owed, but it would be a record keeping requirement. Um, these gifts, 19,000 or less, don't reduce your lifetime exemption, but over that, it would start to keep track of that reduction, kind of like a scorecard. HSA limits, just a slight change there. Um, and again, there is for those 55 and older, you could do 1,000 more. Um, one thing to point out there, if it is a married couple with both 55 and older, you each can do 1,000 catch up then extra amount, but you would have to have a separate account for the other spouse. If it's just one HSA account, it would just be the one $1,000 extra amount. I'm going to skip through a few of these things just so we can make sure we cover everything in the time that we have. All right. So yeah, a lot on HSAs and become quite popular. This is an important thing for this year. The IRS is no longer going to be sending out paper check refunds. So it'll be important to make sure to set up direct deposit information on your individual return if you are lucky enough to have a refund. Um, this they decided that, I guess, just for efficiency to save the cost of mailing checks. I think it makes sense. There are some exceptions. So we've been filing returns here already this season and have had a few exceptions where we can indicate that a person, there's a reason that they don't have it. If you don't, the IRS will send a letter requesting to get information, or if you do meet the exception, to get a paper check. So this will be a bit of a new thing for some folks that like to get checks for refunds. They'll have to adapt to this. So this again is just pointing out what I mentioned earlier, just that catch-up contribution will have to be a Roth contribution for certain people. So I guess I didn't point that out earlier, but if your W-2 income was 150,000 or more, then it would apply. If it had been under that the year before, then there would not be that requirement. Let's just skip through here so we can keep moving. So this is just a summary of the few pages I skipped through, kind of debating whether it might be better to make a Roth contribution versus a deductible contribution. It can be argued, I think, either way. I mean, the current tax savings are usually, beneficial. Um, Getting dollars into a Roth and getting that growth in there tax-free certainly can also make a strong case for doing that when you have a chance. We like to recommend, I guess, a mixture of both approaches. Some tax saving contributions plus some Roth contributions, giving you a few different buckets to pull from later on in retirement years. Here's a little more detail on that super catch-up, um, just so you can kind of see what that would be. Maybe just scan through that so we can keep moving as well. All right, and then of course, we all know that the One Big Beautiful Bill Act passed this year, and that was an important piece of legislation that narrowly passed, and and was required to extend a lot of expiring provisions. So for tax professionals anyway, we're excited to see that happen, just so we didn't return to higher tax rates and some of the other things that existed prior to the 2017 tax legislation. I'll go over just some of the tax rates and what the standard deduction are and what the One Big Beautiful Bill Act did, or OB3 is, I guess we call it. So for one thing, the standard deduction went up even greater than an inflationary adjustment for folks. So we went, what was scheduled to be 30,000 went to 31,500 for married couples, 15,750 for single, 23,625, and this was made a permanent level. These higher standard deduction came into play, originally in 2017, when the personal exemption amounts went away. And then this, of course, caused a lot of people to end up taking the standard deduction versus itemizing. So that standard deduction will even be larger now that's available. We also ended up, keeping the current tax rates that exist the same. So we have the 10, 12, 22, 24, and so on percent rates. So, which was good to see. When they say this is a permanent change, I guess they are just cautioning that, permanent doesn't mean permanent. Permanent means, during the current administration, it should be permanent. Certainly things could change. So if you're making decisions on Roth conversions, this may be a prime time to be looking at doing that, where rates will likely never be lower than what they currently are. Potentially could be higher. So that is what this slide is pointing out. And then, yeah, a little more detail on that, but that certainly something to keep in mind. There were changes to 529 plans, basically expanding the use of those to take distributions for elementary and secondary school, and increase the amount you can use annually for that to up to 20,000 for K through 12 costs, and it also expanded some of the eligible costs you can use. So yeah, I know probably many of you have been funding 529s, and it is nice that they're more flexible on what you can use them for, that not only, post-secondary costs, but now, like they've been for a while, the K-12 costs, and now even expanded more. Also some post-secondary, credentialing type things are also eligible that had not been before. All right. All right, another one you may have heard about is these new Trump accounts, that these are new for 2026. They can't actually be funded until July 4th, 2026. And I guess the idea behind these is to get kids investing young, getting dollars into investment accounts that can grow. If you start, as we all know, if we start investing early, those amounts can grow to be tremendous amounts. The maximum amount that can be contributed to an account is going to be 5,000 per year. And then you can't take withdrawals until age 18 is the idea here. For one thing to kickstart this, the government is going to give all children born between in 2025 through 2028 a tax-free $1,000 starter amount into this account. So yeah, would have been nice to have that when our kids were born, but I guess it's good for others here. but I think these can make sense. You know, it's a I think should teach people the value of investing early and uh, be interesting to see how this all works out. The other big change as part of this that you've probably heard about in the news would be the SALT limitation. So, under the current uh, or the previous tax law, we were limited to a $10,000 deduction for this whole state and local tax area of the itemized deductions. So that included real estate taxes, income, state income taxes, personal property taxes like license tabs and those things. All of those combined, you could only take a $10,000 deduction as part of your itemized deductions. With that limitation, it caused a lot of people not to have enough deductions to itemize. So this was kind of a big point, and this has been expanded from that $10,000 amount uh, up to 40,000. And this is in effect for 2025 already. And then it'll gradually go up with inflationary adjustments. So scheduled for 40,400 in 2026. And that would be for the married joint. Um, there is a phase out for this. So higher income level folks could have this phased out partially or fully. Um, and if it's fully phased out, it would take you back down to that $10,000 SALT level. Another new thing here that you've heard about are um, special deductions for overtime pay and tips. So this will affect um, some workers. The uh, but for this year, you may or may not get, if you are eligible for this, you may or may not get special reporting by your employer. Employers are not required to report specific information on this until 2026 on W-2s. But you can take information from your pay stub to determine how much overtime pay you received. The part that's going to be the deduction is going to be that premium pay part. So like when it's time and a half, it would be that extra half time. So as a function of the form and the return, if you're eligible for this, it would be dividing the total overtime pay you might find on a pay stub by three to come up with that extra half time to report. Um, The other important one there would be the exclusion of, or the deduction for tip income. Um, Again, this uh, taxpayers can just report information from their own record keeping for this tip deduction again. So important, you need to report the tips as income to be able to take the deduction on them. So it'll be either tips reported on your W-2 or other tips that you declare that you could end up then taking a deduction for. Uh, there has been some regulations issued on this to kind of prevent abuse of this. So I think the thought here was that other professions might decide to pay their employees tips um, to kind of give them this extra deduction, but there are going to have to be just qualifying occupations that can take this tip deduction. As they say here, a lot of the tips end up probably not being reported anyway, so we don't know how much this will actually save. Okay, there's more detail on that we'll scan through quick. Okay, here's another new one. There is now a itemized deduction for car loan interest. And we'll start seeing some reporting on this coming up as well. This is strictly for a loan on the purchase of a new car. So you have to be the first user of it. can also be other vehicles, so it can include motorcycles as well. The final assembly of the vehicle has to be in the U.S., so we're trying to promote purchase of U.S. vehicles, I guess, but that would be the other part, and then it's limited to a $10,000 deduction. You will see 1099 type interest forms starting to come out to report car loan interest. A little more information here for you. This is what that form will look like once they start issuing it. That'll start in 26 when we start seeing these statements coming out. All right, another important deduction that we've seen benefiting a lot of our clients already on the returns we prepared would be the new senior deduction that's in effect for 2025. This came about when there was talk of trying, looking at making Social Security tax exempt. Instead of doing that, they've left the taxation of Social Security to be really the way it has been, the maximum of 85% being taxable in a computation to determine how much of Social Security is taxable. But then instead, they're providing senior citizens for starting in 2025 a $6,000 deduction for those that have reached age 65 by the end of the tax year. So if you turn 65 by the end of 2025, you may be eligible for a $6,000 deduction. There is a phase out of this, of course, like on most things. So the phase out will happen and be fully phased out for married joint at 250,000. So it starts at 150, goes to 250. The phase out for single starts at 75 and goes to 175. This isn't part of the itemized deductions, so you would benefit from this by whether you're taking the standard deduction or itemizing. So that is also a plus. All right, charitable contributions. There's been some changes here as well. Not so much for 2025, but starting in 2026, there will now be a 0.5% floor on determining what your deductible charitable contributions are. So it's going to be, you have to reduce it. Like in this example, if your adjusted gross income was 200,000, a 0.5% of that is going to compute to $1,000. So if you made $10,000 of charitable contributions, you'd only be allowed a deduction of 9,000. There also is a new charitable deduction for those not itemizing. So this is nice to see. So it's $1,000 or 2,000 for married joint that you can deduct whether or not you're itemizing. So it's I think hopefully this will spur some people to make donations that maybe otherwise weren't because they can't itemize. So I'm glad they added something here. And then this is just a note that this floor does even affect non-cash donations to Goodwill and so forth. Another thing just to remind people of is donor advised funds are a great way to make charitable contributions and to make a larger deductible contribution in one year that you maybe want to disperse out over several years from this fund that you create. We've used a strategy with the higher standard deduction here for years of having people try to bunch their deductions in one year to itemize and then maybe take the standard deduction the next year. So this can be done, you could make it, let's say you just would regularly make a donation to a charity annually of a certain amount, you could make that amount the first of the year and then in December of the same year and then skip the next year. That would be a way to do it. Same thing with the donor advised fund, rather than maybe making a contribution of a certain amount each year for 5 years, you do 5 times that amount in one year, have it growing in an investment account, and then you can disperse annual amounts to charities, change that over time. A great way to look at it. The other way to really make this work better would be as if you have any appreciated stocks investments in your taxable investment account, um, by contributing appreciated stock to a charity or to a donor advised fund, you avoid recognition of that gain. Plus, you get the value of the charitable contribution for the fair market value of the donation. Here's just some examples showing that I'll just scroll through quickly. We've seen this a lot with our clients, starting to look to take advantage of this, especially those that would normally make larger donations. The other area that is a great way to save taxes on charitable contributions. So again, with that higher itemizing level or standard deduction level, where a lot of folks would not have enough charitable contributions in itemized deductions to get a benefit from it. A better way for those that are age 70 and a half or older is to make a qualified charitable distribution from an IRA so this can, satisfy your RMD requirement or part of it, but it also can even be done before you're required to make RMDs, as long as you're age 70 and a half. These dollars would go straight from your IRA to a charity, then it would be excluded from taxable income on your individual return. So this is a better tax treatment than an itemized deduction, even to itemize, you usually lose something just to get to the level to itemize. This is all saving above the line, reducing your adjusted gross income by the amount that would transfer directly to charities. There is going to be a little bit new reporting on the 1099-R that will indicate if there was a qualified charitable distribution. Normally, we have to rely on information from your investment company and a letter from the charity with documentation. I still wouldn't trust that these new 1099-Rs will show that accurately. This was a little bit of planning I could have done before the end of the year, but a little late now. So the energy area, there were changes as well due to the One Big Beautiful Bill Act. Most of them to the negative in this area. So the credits were available for clean vehicles ended September 30th, 2025. So on Teslas and so forth. Residential energy credits ended at the end of 2025. So if you made some energy efficient improvements in 2025, you're still eligible for these credits, but after that, they currently don't exist. These would be things, can be furnaces, air conditioners, water heaters, energy efficient windows. So they do have to meet that requirement. It can be energy efficient doors, garage doors, insulation, those things. Also, the credits for the solar panels. I've seen a lot of those being installed. That also went through 2025. Back to talking about itemized deductions. There previously had been a phase out of itemized deductions for high income earners. That went away temporarily. It is back starting in 2026, but in a different format. So this calculation is this 2/37 calculation, which I'm not sure how they came up with that, but um, we're we're going to see that kick in for people that are high earners. Um, Other than that, others will keep most of their itemized deductions. And then we have just a few other things we want to touch on here. So um, the child tax credit did go up to 2,200. Um, Again, a lot of these things were set to expire, so we're good to just see them that they were kept at these higher levels, and then it also went up to be, or it's going to be indexed for inflation going forward. Another, I guess I'd say negative part of this bill is that that back in 2017, the tax bill eliminated the miscellaneous itemized deduction category. This would be an area where you could deduct unreimbursed employee business expenses, investment expenses, sometimes tax prep fees, um, those things. Uh, that whole area of itemized deductions was eliminated then. It remains eliminated under the new tax law. The only the only instance where it can be really used is for educators for a small the small above the line deduction of up to 300, and then they can also take a miscellaneous unreimbursed education expense. So those are really the only folks that'll benefit from it. Another negative, I would say, from the new bill is the treatment of gambling income and losses. Um, this is starting at 2026, but any of you that are gamblers, pay attention to this because in the past, if let's say you lost more than you had in winnings, you could deduct up gambling losses up to the amount of your wagering winnings. This is now going to be limited. Your losses are going to be limited. So even in that same instance, you could only deduct 90% of that amount. So there's going to be, we already see it affecting returns, before this limitation. But this will be more important to pay attention to or to potentially curb your gambling. Uh, the other thing to know, and we encourage our clients to take advantage of this, but the IRS Chief Counsel years ago issued a memo, this back in 2008, that was saying gamblers really should be reporting gambling on a per session basis. So not necessarily just going by your W2G reported amounts, but really looking at it each day. So if you were to go to a casino, like in this example, hit two jackpots at 2,500 each, you had 5,000 of winnings, but then you lost 5,100 putting money back into machines that same day. Um, the what you would want to do is actually report that as just $100 loss for that day, rather than reporting the 5,000 of income, 5,100 of losses, because that would compute out much worse for you. The difficulty with it is the W2Gs are what's getting reported to the IRS. So in this type of reporting, there is the risk you'll get a notice. But as long as you keep good documentation, you should be fine. Another, I guess, negative is that we may see AMT tax showing up on returns again. The We haven't seen it very often the last several years, just because uh, the higher exemption amount was uh, really calculating, very rarely calculating an instance of AMT. The the phase out percentage changed is what happened here primarily in this calculation. So it's going from a 25% to a 50% phase out range, which is going to speed up the phase out. Um, so I think we will start seeing that again. It's going to be high income people, people with maybe very large capital gains could see this kick in as well. Just some updates here. Dependent care, updated caps, adoption credits. There's been improvement there for anyone that's eligible for that. And then there is a new opportunity beginning in 2027 to donate to particular scholarship funds that would provide scholarships to elementary and secondary schools um, for certain, lower income students uh, to allow them to go there. So there's going to be some new incentive, so you can watch for that. All right. And then just to kind of go back, some of these things are starting in 2025. Some aren't starting till 2026. So just kind of, we can just refresh what we went through already on those. So that increased standard deduction is already happening in 25. All of these things are happening in 2025, which would be that higher SALT limitation of 40,000, that car loan interest deduction, that overtime pay deduction, the tips deduction, that new senior deduction of 6,000 per person that is age 65, that increased child tax credit, and then our uh, energy credits ended here and are still eligible in 2025, but end at that point. These are the things that will be new in 2026. So that AMT tax change, the Trump account starting July 4th. The new charitable deduction for non-itemizers, so up to the 1,000 or 2,000 there. That new floor on the itemized charitable deductions. The educators being able to take that miscellaneous itemized deduction if you had unreimbursed expenses. That new wagering loss limitation to 90%. And then that phase out for certain high income people on the itemized deductions. Those are kind of the big ones. So that's kind of a roll through most of those individual changes. Um, I'll touch on a few other points here, and I'll probably skim through some of this, but just a few of the other changes going on with the IRS for you to be aware of. Um, if you ever do receive a penalty from the IRS, just know that the IRS does have a first time penalty abatement process that they offer, that you, in the past, you would request that. And maybe if it was a very small penalty, you maybe not want to request it and save it for a time when you might have a larger penalty. Looks like the IRS is going to start just automatically approving a first time abatement for penalties. So that would be something to watch for. Just a note on your IRAs, always important to make sure you have your beneficiaries defined properly so things don't happen unexpectedly. We occasionally will see folks assign their own estate to be the beneficiary of their IRA. It's not normally recommended. If that income is taxed at the estate level, you quickly get into higher tax rates. So the estates have kind of the same tax rates as individuals, but they're very more compressed bracket ranges. So you quickly advance through the 10, 12, 22, 24 brackets into the higher rates. If there are distributions made out of estate to beneficiaries, then that income would pass through and be taxed at the individual level. So there are ways to, if this is the case, there are ways to kind of take care of that and avoid that. But but in general, you may not want to do that. Other considerations, though, for beneficiaries. I mean, just met with someone yesterday. They have a lot of charitable intent at the time that they pass away. They have listed charities uh, as a beneficiary of the IRA, which will reduce their taxable estate at that instance. Their thinking there was they're leaving other assets, other like their brokerage assets to their heirs, where they'll then get a step up in basis to fair market value on those assets. They didn't want to leave those heirs with tax liability for when they take amounts out of an inherited IRA. So that was the decision they made, was to make the charity the beneficiary of the IRA, make the heirs the beneficiary of their taxable account. Um, the other the other thing on this is, yeah, surviving spouse is a wise choice to be sole, beneficiary of that IRA. So the uh, the spouse is able to use their own, treat it like their own as far as RMD requirements. So it's a lot different than the 10-year distribution requirement for others inheriting IRAs. And a little more detail there on that topic. And, all right, so I did want to just get to this area here. So this will probably be the last area I'll cover, and then we can open things up to questions. Um, the other big important thing that was defined in the new tax bill was the increase in the federal estate exemption to 15 million. So in 2025, it was 13.99, and it was made 15 million, and again made permanent, or so-called permanent, um, at this level. So uh, this is great news. The federal state tax laws have bounced around over the last few decades to very small amounts, to going away, to being large amounts, to smaller amounts. So good to see this established at a $15 million level. And so a lot of our, the vast majority of our clients aren't going to have a federal estate tax issue. Now, depending on the state you live in, that may be different. Um, Unfortunately, in Minnesota, we do have a $3 million level to reach a taxable estate in Minnesota. So, so we that's we that will be very common for our clients to have that level of an estate that may require some planning for. Um, the the other thing to remember is that, yeah, making gifts sooner would just start to use up this $15 million amount. So, for most of us, any large gifts we make are never going to cause a federal gift tax or eventual federal estate tax. So it shouldn't feel limited to that $19,000 annual amount we talked about before. It does just require that gift tax return filing. And this does talk just a little bit about, yeah, Minnesota clients definitely need to still be doing planning. Um, the other thing to know is if you're doing gifting, so that could actually be a smart move there, is to gift things to others prior to death. If you do that at least 3 years before that, it doesn't get brought back into your estate. Minnesota state rates range from 13 to 16%. I think that is the end of what I wanted to cover here. So I think I can see if I can stop my sharing here, and then we can just answer questions that anyone has.
All right. If anyone has a question, either you can type it in the chat or you can go below to I think it's in the, yes, if you go below and you click react, you can raise a hand and then we'll call on you to ask a question. So either way, if anyone has any questions for Mike, thank you so much. It was excellent information. A lot of changes this year with the tax laws. So we appreciate all the updates. Some very, very good updates there. Okay, does anyone have any questions for Mike? The other option is to reach out to your financial advisor that invited you here. And ClearStep Financial does appreciate you being on the webinar today to get this information. So I think that's it, Mike.
Okay, very good.
All right. Thank you. Thank you all for being on the call today. Have a great day.
Okay, thank you, everyone.
Thanks, Mike.
Yep,
Appreciate it.
bye-bye.
Okay, bye-bye.